In 2007, the richest man in the world paid nothing, $0 in federal income tax. Jeff Bezos did it again in 2011. In 2018, Elon Musk, second richest person on the planet, also paid zero. And across 5 years, from 2014 to 2018, the 25 richest Americans, Bezos, Musk, Bloomberg, Buffett, Carl Icahn, and the rest, got $401 billion richer while paying a true tax rate of 3.4%. $3.40 on every $100 they gained. You, on a salary, are probably somewhere around 22. So here's the question worth the next 12 minutes. Where does that difference actually go? Because it doesn't disappear, it moves. And once you see exactly how it moves, you will never look at a tax bracket the same way again. Start with that number because it is slippery. 3.4% is not the rate they pay on a paycheck. Most of them barely take a paycheck. It is what ProPublica called the true tax rate, the tax actually paid measured against how much richer they actually got. By that measure, Warren Buffett's rate was 0.1%, 10 cents for every $100 he added to his fortune. A nurse earning $60,000 pays more than that before lunch on her first day. Now, the official numbers are gentler. The White House's own economists put the 400 wealthiest families at about 8.2% once you count their gains, and critics argue the honest figure is higher still. We will come back to that fight, but hold the shape of it. The more you make from owning things, the lower your rate falls. If you have ever wondered where your money really goes every time the government takes its cut, that is the whole point of this channel. Subscribe and we follow $1 all the way down, one product every week. Because here is the thing nobody tells you. None of what these men did was a crime. There is no secret island in this story, no briefcase of cash. Every move you are about to see is legal, written into the code, and done in daylight. The trick was never breaking the rules. It is that the rules were built to tax income, and the very rich do not really have income. They have something better. Here is the first move. Call it buy. When you earn a wage, the government taxes that income the moment it lands. When you own a company, you mostly do not get paid. You get richer on paper as the stock climbs. And paper gains, what the code calls unrealized capital gains, are not income. Not a cent of tax is owed until you sell. So the billionaires simply do not sell. Musk holds Tesla. Bezos holds Amazon. Bloomberg holds Bloomberg. On paper, they earn tens of billions a year. On the tax return, almost nothing, because nothing was sold. And remember the baseline you are measuring against? In 2021, the average American paid an income tax rate of about 15%, and a typical professional sits squarely in that 22% bracket. The billionaire, in a good year for his stock, can pay a rate with a zero in front of it. As of 2022, America's billionaires and centimillionaires were sitting on at least $8.5 trillion of these untaxed gains. $8.5 trillion of wealth the IRS has, by design, never touched. This is what Buffett meant for years when he said he pays a lower rate than his own secretary. He was not confessing. He was describing the blueprint. The first rule of the game is the simplest rule there is. Do not sell, and you do not owe. The fortune grows, the tax bill does not, and you have not technically made a single dollar. But that creates an obvious problem. If you never sell, how do you buy anything? The mansion, the jet, the rocket company, that takes cash, and you cannot pay for a $100 million house with stock you refuse to sell. So here is the second move, borrow. You do not sell the shares. You walk into a private bank, put the shares up as collateral, and borrow against them. The bank is delighted. You are the safest borrower alive, backed by Amazon or Tesla stock, and the cash you walk out with is a loan. A loan is not income. It is not taxed at all. The whole market for these securities-backed loans reached roughly $138 billion by early 2024. This is exactly the kind of thing the cut exists to follow. The dollar sitting right in front of you, quietly doing something you were never told about. Subscribe so you do not miss the next one. So picture the full position now. The billionaire is spending millions, living enormously, and reporting an income so low it could qualify a normal family for help. The stock keeps climbing. The loan just sits there. The interest is a rounding error, next to gains compounding above it. He is spending his entire fortune without ever officially earning a dime of it. Buy gets you the asset, borrow gets you the cash, and neither one triggers a tax. Which leaves one last problem, and it is the one nobody likes to say out loud. Eventually, you die, and the loans come due. The whole tower of borrowed money has to be settled against the estate. Surely this is where the tax finally lands. This is the reveal, and it is the part that catches almost everyone. It does not land. When you die, the assets pass to your heirs, and their cost basis is reset to the value on the day you died. It is called the stepped-up basis. Every dollar of gain that piled up over a lifetime, the millions, the billions the stock climbed while it was never sold and never taxed, is simply erased, wiped to zero. The heirs can sell the next morning and owe capital gains tax on nothing at all. So look at the whole machine. You buy and never sell, so there is no income to tax. You borrow against it, so you get the cash without selling. And you die, and the gain vanishes before anyone can touch it. Buy, borrow, die. 3 moves, every one of them legal. The largest pile of private wealth in human history, and the tax bill at the very end of it can round all the way down to zero. That is not a man cheating the system. That is the system, finishing exactly as it was drawn.
So if the tax never lands, where does the money actually end up instead? Follow it forward. A lot of it flows into stock buybacks. Companies spending their profits to buy back their own shares, which pushes the price up, which makes the owners richer, untaxed all over again. In 2024 alone, the S&P 500 spent a record $942 billion buying back their own stock. Apple by itself spent $104 billion. Some of it goes to charity, sort of. The favorite vehicle is the donor-advised fund, where you collect the full tax deduction the moment the money goes in, but there is no legal requirement to ever hand it to a working charity. By 2024, those funds were holding $326 billion, money that already earned its tax break, parked, possibly forever. And here we owe you that fight we promised earlier. Defenders of the rich make a fair point. Count the corporate taxes their companies already pay, and the true rate on the top 400 climbs back toward 23% by some estimates. It is a real argument, and we are not going to hide it. But notice what it admits, that the headline individual rate really is that low, and that the math only works if you credit them for a tax the company paid, not the person. And honest economists will also tell you the loans are not even the main event. For most of the ultra-rich, the real move is the quietest one. Just hold and let it compound untaxed year after year. None of this hides in an offshore vault. It sits in annual reports and philanthropy filings, in plain sight. The gap between 3% and 22% does not vanish. It compounds on the private side of the ledger, buying back shares, sitting in funds, growing. Now here is the other ledger, yours. When 22 cents comes out of your dollar, you can actually watch where it goes. In 2024, 21% of all federal spending went to Social Security. 24% went to healthcare. Medicare by itself was $912 billion. 13% went to defense. And 13%, more than defense, more than Medicare,
went to nothing but interest on the national debt. The rest, about 29%, is everything you actually picture when you picture government: roads, schools, veterans, food safety, the parks, the science. Every cent of it tracked, line by line, because it came out of taxed income, yours. That is the real comparison this whole episode is about. Not good people against bad people, two different sets of rules. Your money is income, so it is taxed before you ever see it, and it funds the country. Their money is gains, so it is not income, so it is not taxed, and it funds itself. So here is the kicker. The next time you hear that a billionaire paid a lower rate than a school teacher, you will know it is not some loophole a lawyer forgot to close. It is the design. Buy, borrow, die, working precisely as written. You paid your 22%, and it bought Medicare and the interest on the debt. They paid 3%, and the rest is still theirs, quietly compounding. Everyone takes a cut. Now you know who took yours.